Your money-making broadcast starts now. Markets closed mixed on Bay Street and Wall Street this evening. This is the Canada edition for May 4, 2026. I am Chloe, and here is your evening market close recap. Crude oil surged past $105 a barrel today, up over 3%, driven by escalating tensions in the Strait of Hormuz. Nearly 20 million barrels of oil pass through that narrow waterway every single day, and any disruption there sends immediate shockwaves through global prices. For Canadian investors, energy is the story of the year, and it is getting bigger by the day. The TSX Composite showed real dispersion today, with energy names defying gravity while banks, technology, and consumer stocks lost ground. Let us walk through what moved markets today, what it means for your portfolio, and which stocks deserve your attention this week. Let us start with the Strait of Hormuz crisis. This is the single biggest geopolitical story affecting global markets right now. With oil at $105 and analysts projecting $125 in the coming weeks, Canada's energy sector is in an enviable position. We are the fourth largest oil producer in the world, and instability in the Middle East reinforces the strategic importance of Canadian energy. The Strait of Hormuz handles roughly one-fifth of the world's oil supply. Iranian naval exercises near the strait over the weekend raised fears of supply disruptions, adding a risk premium of several dollars to every barrel. For Canada, this is a structural advantage. The Trans Mountain Pipeline expansion is now fully operational, giving Canadian oil producers direct access to Asian markets. Every barrel that Asia buys from Canada, instead of the Middle East, strengthens our energy security narrative. Canadian heavy crude, Western Canadian Select, is trading at a narrower discount to WTI, reflecting this increased strategic value. Producers are generating free cash flow at record levels, and many are using it to pay down debt and return capital to shareholders. Tourmaline Oil, Canada's largest natural gas producer, hit a new all-time high of $66.94 today. TOU.TO benefits directly from this macro environment. The company has one of the lowest cost structures in the industry, with all-in sustaining costs well below $20 per barrel of oil equivalent. Management has been disciplined with capital allocation, prioritizing debt reduction and shareholder returns over production growth. The balance sheet is strong, with net debt to EBITDA among the lowest in the peer group. This crisis is accelerating the investment thesis significantly. The father of value investing, Benjamin Graham, once said that the intelligent investor is a realist who sells to optimists and buys from pessimists. He believed discipline and a margin of safety were the keys to long-term success. Right now, the pessimism around global stability is creating opportunity for those who understand the structural need for Canadian energy. This is exactly the kind of disciplined operator he would appreciate, buying assets when they are out of favor and generating returns through operational excellence. We are also seeing renewed debate about pipeline capacity across the country. Suncor, Canadian Natural Resources, and TC Energy are all names to watch closely. ENB and TRP provide the infrastructure backbone that gets oil to market, while SU and CNQ are pure producers riding this crude wave higher. The TMX ramp-up has been smooth, and additional throughput could come online if the political will supports it. Over the weekend, Berkshire Hathaway held its annual meeting in Omaha. This was Greg Abel's first solo meeting as the designated successor to Warren Buffett, and his remarks on energy were telling. The key takeaway for Canadian investors is clear. He emphasized that Berkshire's confidence in Occidental Petroleum is long-term, and that OXY's competitive advantages extend well beyond the current oil cycle. Occidental's position in the Permian Basin, the most prolific oil field in North America, gives it a cost advantage that few competitors can match. Additionally, OXY is a leader in direct air capture technology through its 1.5 joint venture, building what will be the world's largest facility of its kind. This could become a significant revenue stream in a carbon-conscious world. OXY closed at $60.18, up 2.5% today, and it continues to be a direct and powerful play on the oil supercycle. Berkshire owns roughly 30% of OXY. When the world's most famous investor puts billions into oil and gas, Canadian investors should pay close attention. The legendary growth stock investor, Philip Fisher, taught us to buy when you find extraordinary products and extraordinary management. He believed thorough research and patience were the keys to outsized returns. Fisher famously used the scuttlebutt method of gathering information from customers, competitors, and suppliers before investing. He looked for companies with durable competitive advantages. Occidental is precisely that kind of opportunity, with Permian assets, carbon capture leadership, and the backing of the world's most famous investor. In Washington, the Fed transition is taking shape. Jerome Powell is staying on as a Fed governor while Kevin Warsh is the frontrunner for chair. Warsh served as a Fed governor during the 2008 financial crisis, and has publicly argued that the Fed was too slow to raise rates in 2021 and 2022. He is known for his hawkish views on inflation. This transition brings rate path uncertainty for markets. The Bank of Canada follows the Fed's lead closely. If the Fed stays hawkish while the Bank of Canada moves toward cuts, the rate differential widens and the Canadian dollar could weaken further. That is actually a tailwind for Canadian energy producers earning in US dollars. Every 1 cent decline in the loonie adds millions to the bottom line of producers like Tourmaline, Suncor, and Canadian Natural Resources. Higher oil plus a weaker loonie means record cash flows for Canadian energy companies. The April jobs report is coming up this week. The non-farm payrolls report, due out this Friday, is one of the most anticipated releases of the year. Consensus expectations call for around 200,000 new jobs, which would signal a still tight labor market. Kalsher prediction markets suggest there is upside risk to that number. If the report comes in hot, the case for rate cuts in 2026 weakens significantly. That would be a headwind for rate-sensitive sectors like housing and consumer discretionary, but a continued tailwind for energy and commodities. For Canadian viewers, a strong U.S. jobs report also signals healthy demand for Canadian exports. The legendary Fidelity fund manager, Peter Lynch, reminded us that the stock market is not the economy. He said time in the market beats timing the market. He believed in buying great companies at reasonable prices and holding them through economic cycles. Strong companies with solid fundamentals can outperform regardless of the macro environment, and individual stock research still matters more than macro noise. Jamie Dimon sent a warning shot this week. The CEO of J.P. Morgan Chase flagged a potential credit recession, pointing to bond market volatility and deteriorating corporate credit quality. For fixed income investors, this is a wake-up call. Canadian banks with exposure to corporate and consumer lending could face headwinds. This is why energy and commodity exposure makes sense as a portfolio hedge. Real assets are outperforming while credit signals stress. Anthropic, backed by Goldman Sachs and Blackstone, announced a $1.5 billion AI venture fund today. Institutional money continues to flow into artificial intelligence at an accelerating pace. The world's top innovation fund manager, Cathie Wood, has been beating the drum on AI for years. She argues innovation-led growth is a multi-year theme. She believes breakthrough technologies create compounding growth opportunities that most investors overlook when they focus on short-term macro noise. Semiconductor plays and cloud infrastructure offer AI exposure without the hype. Let us talk individual TSX stocks. Beyond Tourmaline at new highs, today was a story of two markets. Financial stocks on the TSX were under pressure, with the big six banks losing ground as the yield curve steepened and credit concerns mounted. Technology names also struggled, dragged down by the broader rotation out of growth into value. Gold miners held relatively steady, with bullion around $2,350 an ounce. But beneath the surface, the dispersion was extreme. We saw notable new lows. AFN.TO hit $19.80, LIF.TO dropped to $28.02, POW.TO hit $75.75, and CCL-B.TO fell to $83.20. Real dispersion means real opportunities. The pioneer of global contrarian investing, John Templeton, said the time of maximum pessimism is the best time to buy, and maximum optimism is the best time to sell. He believed contrarian thinking was essential for superior results. Now for stocks for your watch list. First, Tourmaline Oil, TOU on the TSX at $66.94 at today's new high. Canada's largest gas producer benefiting directly from the energy crisis. Momentum is strong, cash flows are enormous, and the balance sheet is pristine. He would see this as value investing in action, buying Canadian energy when global pessimism is high but the structural demand has never been stronger. Second, Occidental Petroleum, OXY at $60.18. He's largest energy bet outside of Berkshire. Berkshire owns roughly 30% of OXY. Beyond the Permian assets, the carbon capture business adds long-term upside. Every time oil rallies, OXY rallies with it. A simple, powerful trade. He would approve of this exceptional company with exceptional management and a durable competitive advantage. Third, Oracle, ORCL, at $180.35, up nearly 5% today. Oracle has reinvented itself from a legacy database company into a cloud computing powerhouse. Its cloud infrastructure business is growing at over 50% year-over-year, and it signed several major AI training contracts this quarter. Not the flashiest AI name, but one of the most effective. Oracle offers an established, cash flow positive way to play AI at a reasonable valuation. He would appreciate a company you can understand with real earnings and a durable competitive position. Fourth, Micron Technology, MU at $576.45, up over 6% today. Semiconductors are the backbone of AI. Micron is the largest US-based memory chip manufacturer, producing DRAM and NAND flash for data centers, smartphones, and EVs. Its HBM3E high-bandwidth memory is used in NVIDIA's latest AI accelerators. The memory cycle is turning, with analysts seeing strong recovery driven by AI demand. MU offers pure-play semiconductor exposure with a cyclical upturn providing additional momentum. She would see this as exactly the kind of innovation-led growth opportunity she champions. As we navigate this complex market environment, remember what all 5 of our featured investors have taught us today. Graham's discipline teaches us to buy when others are fearful, and to always demand a margin of safety. Fisher's vision reminds us to focus on exceptional companies with durable competitive advantages, and to do the research before investing. Lynch's pragmatism tells us that individual stock research still matters more than macro noise, and that great companies can outperform through any cycle. Wood's conviction shows us that innovation is a long-term theme worth investing in through the ups and downs. And Templeton's contrarian instinct urges us to look where others are not looking, especially during times of maximum pessimism. Oil above $105, a new Fed chair on the horizon, credit warnings from Wall Street's top banker, and a jobs report that could reshape the entire rate narrative. There is no shortage of things to watch. But for Canadian investors, the path forward is clear. Energy is the story, and it is not over yet. I'm Chloe. See you tomorrow. I'm Chloe. See you tomorrow. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.